Capital gains tax is the tax you pay on the profit made when you sell an asset for more than you originally paid for it. These assets can include stocks, bonds, real estate, and other investments. The tax applies only to the gain, not the total sale amount. For example, if you buy shares for $1,000 and sell them later for $1,500, your capital gain is $500, and you owe tax only on that $500. There are two types of capital gains, short-term and long-term. Short-term capital gains apply to assets held for 1 year or less and are taxed as ordinary income, meaning the tax rate matches your regular income tax rate. For instance, if you're in the 24% tax bracket, you'll pay 24% on short-term gains. Long-term capital gains, on the other hand, apply to assets held for more than 1 year and are taxed at lower rates, usually 0%, 15%, or 20%, depending on your income level. For example, if your income places you in a middle tax bracket, you might pay 15% on long-term gains instead of the higher short-term rate. Some exceptions exist. For instance, when you sell your primary residence, you may exclude up to $250,000 in capital gains if you're single, or $500,000 if you're married filing jointly, provided you meet certain ownership and use requirements. You can also offset capital gains with capital losses. If you sell an asset for less than you paid for it, the loss can reduce the taxable amount of your gains. For example, if you made a $1,000 gain on one stock but lost $400 on another, you'd only be taxed on the net $600 gain. If your losses exceed your gains, you can deduct up to $3,000 of those losses against your other income, such as wages. Some investments, like collectibles, may face higher tax rates, while others, like retirement accounts, e.g. 401k, or IRAs, allow gains to grow tax-deferred until withdrawal. Special rules may also apply to certain types of investments like small business stock or real estate. In summary, capital gains tax is levied on the profit made from selling assets. The rate depends on how long you've held the asset and your income level, with long-term gains being taxed more favorably. By holding assets for more than a year and using strategies like offsetting gains with losses, you can reduce your tax burden and maximize your earnings. Understanding these rules is key to making informed investment decisions.